All right, everyone. Welcome to the Stenger Tax Advisory 2024 Political and Tax Outlook webinar. Thank you so much for taking the time to join us. We have a wonderful deck ready to go here for you. We've put some time together, Chris and myself, Chris Jordan, our head of tax, who is on this call as well, to make sure we're covering some of the things that have happened in the past, a little bit about what's going on right now in DC, and then really what's coming down the road. That's what we want to try and do, is to give you tomorrow's news today. We want to tell you where the puck is going, not where it is right now. So that's what we're going to talk a little bit about in today's webcast. And I just want to remind you that this webinar is not individual advice. You shouldn't take it that way. It's general information. And if you'd like to get a little bit more specific with your situation, you need to schedule a one-on-one appointment with either Stenger Tax Advisory with Chris, or with the wealth management side with myself, my business partner, Bon Roth. Just make sure that we have a client agreement in place. We will mention some estate planning items today as well, but Stenger Family Office is not a law firm. So you need to seek either an attorney of your choosing, or we can introduce you to somebody. And that is a little bit of the disclosures. I want to turn your attention, while we let a few other people join in here, to some of the other content that Stenger Family Office puts on. We've got the Nick Stenger Show coming to you every week on YouTube, on Apple, on Spotify. We have another show called Bullish, and we just had Marta Norton, the CIO, Chief Investment Officer at Morningstar. You can't miss that one. That one was phenomenal. Great podcast. Don't miss it. Get on YouTube, get on Apple, get on Spotify, subscribe, watch the rest of the content that we put out. Included in that content is webinars like what we're doing today. And then our big event coming up very quickly, November 7th and 8th, is Investor Day. It's 2025 Investor Day, but as you know, it's this year, November 7th and 8th, downtown Naperville. And we've got Ed Yardeni, head of Yardeni Research, coming in person for a keynote presentation. Get that date on the calendar. We do have a room block available if you're coming in from out of town at the hotel. We'd love to see you at 2025 Investor Day later this year. One of the things that we had last year at Investor Day was a family office panel, which Chris Jordan was a big part of. Chris talked a little bit about taxes at Investor Day. That's how a lot of you met him. And he'll be back on the panel again this year. So don't miss that 2025 Investor Day. The replay from last year's panel is also available online. So I'm going to let Chris go ahead in a couple of minutes here and take us away. But one of the things that we're working towards, and a great takeaway from today's presentation, is this Thomson Reuters custom tax analysis that we can do for you. And this is a projection tool. We pay $30,000 a year for this software. It's an incredible piece of forecasting software that we use, and we can plug in your information. We can do some analysis for you. Chris can sit down with you and say, here's maybe some of the things that are coming in the tax code the next few years, which we'll get into in a few minutes here, and come back to you with a report on some of the things that you might want to be thinking about today. So reach out to Chris for this Thomson Reuters custom tax analysis. Put it in the chat box, and I will just mention we do take Q&A live on this call. So as you're thinking of questions during our presentation, throw them in the Q&A box on the webinar, and we'll be happy to answer those at the end of today's call. So how did tax and Stenger Family Office, how did we start getting tax involved in every discussion? Well, it's simply because taxes are a part of every single piece of our day-to-day lives. The government taxes us 15 different ways. They tax our ordinary income. They tax our investment income. Then they tax our money when we make capital gains. They tax us on our property, which we already own. Then they tax us when we go to the store on sales tax, which was already dollars that we were taxed on in the beginning. And then to top it off, at the end of our lives, they hit us over the head with a wealth tax and an inheritance tax. And so that's why tax is such an important piece of the equation. So, Chris, I'm going to let you take it away from here. What are some of the things that you're worried about or thinking about with the tax code right now?
Yeah, thanks, Nick. Thanks for having me. And don't forget the payroll taxes as well. It's one of the other ones to add to the list. Yeah, it's certainly an interesting time on the tax side with, both politically, we all know with the elections coming up later this year, But really, the major tax bill from recent memory, the Tax Cuts and Jobs Act, a lot of those provisions are expiring here end of 2025. So if you couple that with the elections this year, we're really heading towards a pretty big tax cliff that, either way, either something's going to get passed, or nothing's going to happen, and a lot of things are going to expire. So we're really entering one of those big change years on the horizon. Something's going to happen either way, and we kind of need to be prepared for it. Just like we were when the Tax Cuts and Jobs Act was first passed, signed right at the end of December there in 2017. Gotta love the government giving us 1 week to kind of prepare for some of those changes. But it was when that was passed, that was major change to the tax system. A lot of people say it was, the biggest one in 30 years at that point in time. A lot of things were starting then January 1st of 2018. And like I mentioned, we got a lot of things that are going to expire at the end of 2025. So a lot of things to be considering here as we kind of move forward, both with the presentation and with the elections later this year, and with just the calendar turning, with 2024 here. So I think we kind of jump. Go ahead.
Yeah, Chris, no, I'll let you go ahead to this next slide. I mean, you have it broken down into individuals, businesses, and I think trusts. So go ahead and let's talk a little bit on the individual side.
Yeah, and I think our goal here today is to educate everybody first, kind of what were those big changes, and what is under current law. Nothing is passed. What's going to revert back to starting in 2026. So either way, a new tax bill will get passed, or a lot of these things will revert back to pre-2018 tax figures. So kind of prepare you for where we're at now, what's on the horizon, and then kind of go through some of those planning concepts and things that we're doing with our clients now, even with knowing the changes on the horizon on the tax side. So kind of highlight some of those big changes with the Tax Cuts and Jobs Act. The biggest one was just the widening of the tax brackets. So like you may know, in the federal tax system, it's a bracketed system. So the first set of incomes taxed at 10%, next set of incomes taxed from there. So it kind of keeps going up on a gradual system. So the TCJA increased those brackets and dropped that highest rate from 39.6 down to 37, and changed some other brackets. So that was really a big change there. They got rid of the personal exemptions. So before, everyone, married couple would get an exemption for each person, about $4,000 each. Technically in the tax code, the exemptions are still there, but it's a $0 exemption under the current standard. So those are gone. But what they did is they increased the standard deduction that goes to everybody. So they almost doubled that. So that was increased for everybody as like a flat amount. What you do though is you can always compare that to your itemized deductions, and then you take whatever's higher. But what they did for those that live in a high tax state, like Illinois, where our headquarters is located, they limited the state and local taxes to 10,000 total. So that includes everything from your income taxes, your property taxes, and everything is kind of included in there. So once you hit 10,000, you're not getting any tax benefit of those taxes above that amount. So that's been a big one for a lot of our clients, which leads to many people just taking the standard deduction nowadays. But some of the other things they did on the individual tax side is they did increase the child tax credit and created a new $500 credit for other dependents, typically for those children who phase out of being a child tax credit once they hit college age, things like that. So you can still get a little bit of a credit there for them. So that was some of the big changes on the individual side. If we kind of jump to the businesses, this is where the major tax upheaval came about with taking the corporate tax rate which was on a bracketed system, and just switched it to a flat 21%. So a significant decrease in the business tax there. And then to make up for that, for the pass-through entities, things like partnerships and S corporations, they created this entirely new Section 199A deduction, the qualified business income deduction. A lot of us refer to it as QBI. And what that is a 20% reduction on the net income that you pay tax on. So for a lot of pass-through businesses, on the personal return where the income's taxed, they're only paying tax on 80% of the net income. So it was really a major change, and really had never been seen before, and still has a lot of questions today in terms of how is it truly being calculated. There's a lot of different limitations, thresholds, different classifications for types of businesses. So there's still many unanswered questions as we work with that deduction. But that was really a huge change for those businesses, as well as some other things like changing the accelerated depreciation for fixed assets and business interest for those like higher earner businesses. So really a lot of changes on that front. And like I mentioned, the TCJA, when that was passed right at the end of 2017, kind of for two reasons. A lot of these, especially the individual tax provisions, are going to sunset at the end of 2025, mainly for two reasons. One, they knew that the elections were going to be this year. So, kind of going into the next year when the changes will sunset, there will be new administrations, there'll be a whole new elected Congress, giving them the chance to enact a new bill, as well as just for the budgetary process with the government. So that's really why a lot of these things sunset. So I want to highlight these because this is the undercurrent law. Like, we know at the end of 2025, this is what's going to happen. So something needs to get passed in order for these limitations, these different tax rates, for them not to be the case for 2026 and going forward. So what we kind of like to do is plan for this scenario with our clients. This is if no tax bill is passed. We'll kind of touch on some other ideas that are floated out there right now currently. And we're always tracking new tax law, but we kind of need to work with what we know. And currently, this is what it is. From the tax brackets are going to decompress, kind of like before, back to 2017. The highest rate's going to go back up to 39.6%. The standard deduction is going to drop. Now, it's not going to be exactly 6,500 and 13,000 as standard deductions. They do index those for inflation, but again, it's going to be about half of what it currently is. And kind of to offset that, the personal exemption will come back. So that will be available going forward. The big one I think a lot of people are looking forward to is the state tax limit of 10,000 will be gone. So a lot of those higher earners and high income states can start benefiting from that again. But things like the child tax credit will drop. And one of the biggest ones that we'll definitely touch on more in depth a little bit later is the estate tax exemption. So that's that tax on the value of one's assets when they pass away. Right now, currently, the exemption's north of 10 million per person, adjusted for inflation, and that's going to get cut in half in 2026 and going forward. So our country's never had that estate exemption decrease over time. So we'll kind of touch more on what that means. But that's a big one for clients, especially in retirement age, to be planning for based on the value of your assets.
Chris, let's shift over, and I know you mentioned this, but some of the proposals come in, and we've gotten a lot of client questions around what happens under another Biden administration. What would happen if Trump were to win election? What are you looking at here with the Biden administration and some of their tax proposals?
Yeah, one of the things that the administration usually always does is releases their annual budget along with their tax proposals. Now, I kind of preface these with, we see this all the time. This is kind of the Biden administration's top goals. This is what they want to accomplish. Now, does any administration ever achieve exactly every single thing that they want? It's never happened. But this is always the starting point. This is what you kind of use when we have one party's tax provisions that they want. Now, I don't expect all of these things to come in place, but I have a feeling that if the Biden administration is still in office after this election cycle, moving forward next year, this is going to be some of the things that they're pushing for in their own tax bill. So their big selling point is that they don't want to increase taxes on anybody earning less than $400,000 per year. That's their selling point. A lot of these provisions are to increase things like the corporate tax, bring that from 21% up to 28%. Still not as high as it was back in 2017, but they do want to increase that. That is also kind of correlated with Biden's corporate minimum tax, which is on those multi-billion billion companies, basically paying a percentage of their book income, not necessarily their taxable income. So that was something that was passed, and really trying to tax those larger corporations. Same thing with those individuals, that he wants to bring that top individual tax rate back up to that 39.6, as well as add this billionaire tax, the 25% minimum tax to billionaires. And probably the biggest one that probably would affect those clients that are kind of even might be below that $400,000 per year is the increase to the net investment income tax. So that's that 3.8% tax on your investment income. Things like interest, dividends, capital gains came about with the Obamacare, when the healthcare was passed. That extra tax was really there to help subsidize that Obamacare, and that really kicks in currently at $250,000 of income. So even if you do have a beneficial capital gain tax rate, typically 15 or 20%, you still might be having that 3.8 net investment income tax on top of it. So they want to expand that. They want to include pass-through business income in that net investment income tax. So some interesting things there. They want to remove some of this like generational wealth transfer with step up in basis on larger gains. But they also then want to help out the lower income with the expanded earned income credit, as well as increasing that child tax credit. So this is kind of like the starting point for the Biden administration. And it's always interesting to see with any legislation, is to see who really controls what areas of the Congress and the White House. It's much easier if the Democrats control both the House and the Senate and the White House to pass a lot of these tax provisions a lot easier. So it's really kind of seeing what the mix is after this election cycle, and I'm sure it's going to start becoming a bigger talking point as we move forward with the elections.
So Chris, do you think if we have divided government in DC, is that really what you're looking for? Would that really put a pause on some of these more radical proposals? Would it help if the Republicans had the Senate, for example, and the House? Maybe Biden, wins re-election. Does that put a backstop against most of these proposals, or is there still a risk there?
I think there's still a risk. I think the one thing that we're kind of running into at this point as a country is the deficit is expanding. There's money getting paid overseas for two different wars going on right now, and there is some recent reporting by the Senate Budget Committee that just extending the TCJA, the past 2025, keep the same provisions there, is that would add about $4 trillion on the deficit over 10 years. So I think Congress and a lot of the budgetary committees are seeing that extending the current tax bill is not going to make up for the amount of spending that we have. So I think both sides are starting to see, maybe on, based on Biden's proposals, I think they're really pushing for more taxation, especially on the higher earners, to increase that revenue from the tax side. But I think the Republican side also sees that it's not going to be sustainable just to extend the TCJA in its current form. So I do think, a divided Congress, with the White House, I think would help to get to remove some of these bigger proposals, to get more of a standard tax law kind of going forward.
Yeah, one of the things we always say in the wealth management business is that inflation is essentially political kryptonite, and obviously we've had some pretty heavy inflation here the past few years. Does that also influence some of what's going on politically with taxation? Is it a matter of, hey, we can't afford to keep printing the money, so we've only got two other options, that's to raise taxes or to cut spending? Cutting spending is also not favorable politically, so is the answer then to say, okay, we'll raise taxes on the wealthy? My question would then be, well, are there even enough wealthy people to go, are out there to basically pay the taxes?
Yeah, that's always the question, right? And I think that's what the politicians need to answer for us. We're still waiting to see truly what the Trump proposals are. Like I mentioned with the budgetary committees, I think they realize they can't just extend, I think politically Trump would want to run on his TCJA on from his end, what a great tax bill it was, just to extend it, keep everything as is. But I don't think that is sustainable from a fiscal policy standpoint. So I think moving forward, they need to determine where is that tax revenue going to come in. And politically, it's not easy increasing taxes. I think that's why the Biden camp has kind of floated that $400,000 income threshold per year as a both a policy standpoint, but also a marketing feature as well. That yes, they do want to increase taxes, but not on anybody earning less than 400,000. So I think that might be the strategy kind of moving forward. But there's going to be some increases, I believe, in the future. Just depends on who and kind of what kind of thresholds that all looks like.
So how much do you think you can rely on their promise that taxes will not be raised on people under 400,000? Do you think it's an empty promise, or do you genuinely think that they're serious about the $400,000 cap?
I think they're pretty serious about looking at that in total. But I do think it's difficult to track kind of on an individual by individual basis. Because like I mentioned, that net investment income tax, right now that kicks in at 250,000 of income. So if they're looking to increase that and expand that, they're not going to increase that income threshold to 400,000 on that extra tax. So things like that are going to go up for those people between that 250 and 400. And a lot of other things too that we see on the estate tax side are kind of downstream effects to those lower income earners. So things like reducing that step up in basis for $5 million in assets, that's going to affect future generations. So somebody that could be earning less than 400,000 is really getting affected by something like that. There's been provisions floated in the past, like removing that step up in basis totally, just in general. And that would really, really change the tax for those people that inherited property like that. So some of those things will still affect less than 400,000, but I think part of their marketing and just the tax brackets in general won't be affected for those under that income.
Yeah, and last question on this, going to your second bullet point there, Chris. So the corporate income tax, one of the things that we dealt with pre-2017 with the Tax Cuts and Jobs Act being passed was you had a lot of offshoring of U.S. businesses where they were looking for more favorable tax environments, and you also had a lot of even countries that aren't too far away from us that are very similar to the U.S. Companies were just moving operations over there to avoid that higher tax. Do you have any concern that we could see some of that offshoring again if the corporate income tax is increased, or even a loss of jobs in the U.S.?
I think it's certainly possible. I think what the Biden administration goal with that increase is to reduce some of the top end executive pay. I think that's really their goal. There is some other provisions like that too in their plan to put caps on the deductibility of higher executives. So I think that's really their goal with that. But I think certainly that could be a side effect of that. Now there has been, at least since 2017, there's been a lot more talk globally of this global minimum tax. So we're still trying to figure out exactly how that's going to work. It's basically trying to get all countries on board to remove some of these tax shelters, to basically say this is your minimum that you have to enforce to try and prevent a lot of companies from going to those tax havens. So there's still some kinks to work out in that plan. But I think definitely, it definitely is a less favorable environment with a higher tax rate in the US.
Chris, let's transition here to this next slide, and let's get into maybe some of the strategies that we would recommend for our clients and some of the things that we've been talking about internally as well. So there's obviously a difference between where you save your money. There's pre-tax, after-tax savings. Let's talk a little bit about the difference between these different places you can save money.
Yeah, I think, the goal with managing these different accounts is how is it going to get taxed and when is it going to get taxed? And if only we knew exactly what the tax landscape and brackets were going to be, years from now when you're drawing on some of these funds, it would make it a little bit easier to manage. But looking at things like traditional IRAs, rollover IRAs from a 401k, those are all pre-tax. So they're only going to get taxed once you start taking them funds out of those accounts, which you are required to do once you hit a certain age. And looking at things, though, I think what the best strategy is to have a balance between the two pre-tax and after-tax accounts. So having those Roth IRAs that don't carry any tax with them when you withdraw, as long as you hit a couple thresholds, things like real estate brokerage accounts, those are all great to manage, especially as people move into retirement age, in terms of managing both the income that they need to live off of, but then also managing the tax bill that comes with it. So having a mix gives you the flexibility to draw on funds when you need them, but also still control your tax landscape, especially into retirement.
Yeah, and Chris, I think one of the big things that also changed in some of the legislation the past few years was the RMD ages. And
Mhm.
we saw it go from everybody was at 70 and a half. Now it's a little bit more convoluted. Not convoluted, but it's gotten more complicated than it was before. And it's really changed the game with how to take money out of an IRA. It's gone from 70 and a half now to a lot of people that are projected to not have to take an RMD till 75. However, then once they start taking their RMDs, if they leave their IRA to a beneficiary, then it sounds like now the beneficiary's got 10 years to take that money out. Is that correct?
That is correct. Yeah, I mean, we're really focusing on that TCJA, but there's been a number of tax bills that have been passed between then and right now, including two secure acts that affected a lot of these IRA rules, both increasing the RMD age, but also that 10-year rule on beneficiaries, and really talk about trying to crack down on the generational wealth. In addition to that 10-year rule, there are certain restrictions on trusts as well. So when you're looking at inheriting IRAs into what used to be called a dynasty trust, now get limited to that 5-year rule on that trust. So really stringent in terms of taking that money out and it being taxed then by the government.
Yeah, and with a dynasty trust, maybe explain the basics of that for everybody that isn't aware of what a dynasty trust is.
Yeah, dynasty trust is really just to keep transferring wealth down the road for one's family, with the goal for it to reach many generations. So how it kind of worked before was somebody would leave an IRA to that trust. What you would do is then use it. It might have still had then RMDs on that, but it would use the age of the beneficiary of the trust. So it would still be stretched over a very long time, definitely not 5 years, with the goal to kind of keep just earning income, maintain the wealth with for the family members over many generations. So just a way to kind of keep it trickling down and down. But a lot of these IRA rules have kind of killed those in recent years. Still, obviously, planning you can do to keep the generational wealth, um, but kind of also depends too on different tax revisions as the Biden administration has kind of come out and said they'd like to kill some of those carryover step up in basis.
Well, and it's also led to, I think, a lot of people rethinking what kind of assets they want to leave to the kids, because it used to be, okay, we'll leave our IRA, kids get a stretch IRA or a stretch distribution to pull the money out, which in a lot of cases was 18 years, 19 years, even 20 years. And now it seems like our advice has kind of changed, and we'll get into this a little bit more in a second, but really it looks like leaving after-tax assets to the kids is almost a better strategy with these new RMD rules.
Yeah, 100%. Yeah, one of the worst assets to pass away with is a traditional IRA, because it's going to carry out that tax to your beneficiaries, which typically what we see is they're in their high earning income years. So now they're just adding income within that 10-year window on top of income that they're already earning from their typical jobs. So it's definitely one of those assets that's not great to pass on. Um, and there's different ways to kind of manage that. So, again, this is just the required minimum distribution that you have to start taking. What we've been doing a lot with our clients the past few years is in this higher, like lower total tax system, is to just start drawing more funds out of there, either through just normal distributions above the RMD amount. If they don't need the funds, reinvest it in a brokerage account, keep invested there. But basically just to lock in that tax at a lower rate than what we think it might be in the future. So that's a great strategy, as well as just doing Roth conversions from your traditional account, roll it right into a Roth IRA, lock that in as long as it's within that account for 5 years, and don't touch it until you're a certain age. There's no penalties and no tax on the earnings there. So it's really a great strategy for those that want to lock in that tax. If you are certain that the tax rates are going to go up, now is the time to do that. There are a lot of considerations, though, looking at the market, because you are locking in both the tax on that conversion, but also the value that you're going to pay the tax on. So a lot of times, I have seen in the past where people convert a large sum over. 2 months later, the market takes a big drop, and now you're paying tax on funds that were once a higher value but are now lower. Now over time you can make up for those returns, but it's really just a timing thing of what's the tax rate, what's the tax bracket, and then what's the value that you're going to convert.
Yeah, and I think you're right, Chris. I think the biggest thing on a Roth conversion, they're not it's not a bad strategy, but you really do have to watch where the market's at, because if you're doing it right now when the S&P is around 5,300, next to all-time record highs, it can be pretty tough to break even with taking the money out and paying the tax today. I think you would agree with that.
Yeah, I would totally agree with that. And really the key to this strategy too is paying that tax bill for the current year with other funds. I've seen it where, let's say you're converting 100,000 into the Roth IRA, but in order to cover the tax, you're going to take it out of that amount. So maybe they convert only 70, 75, 80,000, and that goes physically into the Roth IRA. And you're now just behind the ball, taking money out. Really the tax should be paid with other funds, to really maximize that strategy.
Yeah, great point. Let's move on. And here's another strategy that a lot of people start asking about, is charitable giving. There's a bunch of different ways to do charitable giving, but let's kind of work through these couple of items we've listed. Some are less complex, some are more complex. What is donation bunching, by the way? What is that?
Yeah, I mean, that's probably one of the most simple ones. It's really just this idea of bunching your donations for 2 tax years into 1 year. So this really was prevalent with this higher standard deduction environment. So as soon as that kind of came into play, a lot of people realized they're not even itemizing anymore, because maybe their state taxes are now limited to 10,000, and maybe their total standard deductions at 25,000. So if they have 10,000 for the state taxes, they need 15,000 between mortgage interest and donations to even start itemizing compared to taking the standard. So it's really just this idea of, maybe you donate every December. So maybe 1 year, instead of donating in December, you just push it to the January of the following year. So now you've got 1 year, 1 tax year with 2 years worth of donations to then take the itemized deductions. So it's really just kind of a timing strategy, and keeping track of the tax laws and kind of how much you're donating, to really maximize the itemized deductions in 1 year versus the standard. And it's very similar to like a donor advised fund, where you make a donation, and then that donor advised fund, you can then dictate when and how like the payments go out to charity over time. So kind of the bunching is similar to that. It's just making normal contributions in 1 tax year instead of spreading them over a couple years.
Yeah, one of the best use cases for this, I think, and we get this a lot, like you said, in December every year, is maybe somebody's church is doing a capital raising project, or they're building a new building, or they're raising money for some special fund, and they would like to donate or be part of that special fund. We have sometimes advised that, like you said, they wait till January, and then instead of just spreading that payment out over 2 years, they do it all in that 1 year so they can exceed the standard deduction, especially for retired folks who don't have a mortgage interest deduction anymore and some of the other deductions they used to have.
Mm-hmm. Exactly. Yeah. And a lot of this really just comes down to tracking, paying attention to your tax picture, working with an advisor, and just trying to maximize, between years. There's nothing wrong with doing bunching. It's just paying attention to how what are your total itemized deductions and taking advantage of that. Same with donating stock directly to a charity or church. It's pretty simple. Not all charities accept just a straight transfer of stock, but it really just means instead of liquidating that stock in your investment portfolio and then donating the cash to charity, you just directly transfer the stock. And that avoids having to realize that capital gain, pay tax on it, because you still get the donation to charity, you still deduct the fair market value of the asset. So whatever the fair market value of that stock is on the date of donation is your tax deduction. So instead of having to realize the capital gain, those are great things to transfer. So we look at a lot of that with our clients with that highly appreciated stock with a big unrealized gain. Those are great to either donate directly to charity or to hold on to. And we'll kind of talk about, the estate tax a little bit more, but then you get the step up in basis and kind of reset the clock on that gain. So really one of those two strategies is great with that highly appreciated stock.
So Chris, let's walk through that donation to charity a little bit more in detail then. So basically, if somebody has, let's say, $50,000 of stock, and they might have a capital gain on it, for example, and they want to give that $50,000 to their church, they can literally give that $50,000 to church, and it's considered a complete tax write-off for them, and it's a charitable gift for them, and then the church never pays tax on that stock either, correct?
Mm-hmm. Yeah, that's correct. That's a way to just kind of shift that realized gain from one taxed individual to a tax exempt entity.
Awesome. Yep. And then let's talk qualified charitable distribution. This was also one of the questions that it came in while we were talking. So you can gift part of your required distribution to charity. I think it's $100,000 now is the max. Is that still the right number?
Yep, that's correct. So it's $100,000 up to $100,000 you can give. So if you do have those RMDs on IRAs, you can do this QCD, and basically the money just goes to charity. And what that means is you don't get a tax deduction per se for the QCD portion, but what it means is that portion of your IRA distribution is not taxable. So it can be similar for a lot of individuals just to take money out of the IRA and then donate to charity. But the one thing we do see is that doing the QCD reduces your total income. So it reduces your total AGI, reduces your taxable income instead of it just being a itemized deduction. So what that could mean is that different phase outs are lower, different things like, maybe the net investment income tax, maybe certain things are lower because you don't have actual modified adjusted gross income because of the QCD instead of just donating it directly to charity after you receive the income out of the IRA. So in some cases, it might not matter doing a QCD. In other cases, it might matter a lot. And it's really a nice, easy way to give part of that RMD out to charity directly.
And I think the QCD still kicks in at 70.5, correct?
Mm-hmm. Yeah, that's
okay,
correct.
So even if your RMD wouldn't be until 72 or 73, you still can do a QCD at 70.5 if you really want to.
Mm-hmm. Yep. So it's still an option, and yeah, a great way to give the charity without having to realize income. So
Awesome. Yeah, and then let's talk donor advised funds. So this is getting into some of the more complex strategies. Donor advised fund and family foundation. A family foundation is very complex. I call a donor advised fund almost a foundation light. I don't know if that's the right terminology, Chris, but what is a donor advised fund? How does it work? How do you set it up? And then how do you operate it going forward?
Yeah, those donor advised funds are great ways to fund donations to charity. So So your money, the stock goes in there into these funds, and then you can kind of dictate over time where's that money going, and basically just locks it away without having to directly pay it out to charity all at once. So, if that bunching plan doesn't sound great to you, but you still have the funds available to, maybe you just don't want the charity to have access to the funds directly, or maybe you don't know who you want to give money to. Using a donor advised fund is a great way to put money in there, get the tax deduction for that contribution, and then be able to spread out the actual donations over time. So, and you can keep money invested in that account, so it can keep earning, and all of that income then is kind of, it's not taxed to you. It's all separate tax-free income in that account that will just add to the funds available to go to charity down the road.
And are the gifts that come out of your personal account and go to the donor advised fund, how are those taxed? Are those excluded then from your personal taxes, or how does that, walk us through the mechanism there?
Yeah, so when you contribute to that donor advised fund, that gives you a tax deduction as if you were donating directly to a charity. So if you write a check to your church, you deduct that under your itemized deductions. Same if you write a check to the donor advised funds, you deduct that as an itemized deduction, as a donation to charity. So it's important to consider there are income limitations too on charitable contributions. So a lot of these are at 60% of your income. So depending on your situation, it might make sense to spread those over years, because they're going to get limited and have to be carried over anyways. But they're all great ways to kind of increase that charitable deduction, and especially with the standard deduction potentially, or under current law, it will decrease starting in 2026. One of those things where, if we know that the standard deduction was going to decrease, maybe holding off on some of these donations to charity will give you a bigger tax benefit down the road when the standard deduction is just less than currently is. To kind of gauge it that way, especially if the tax rates and brackets are going to be higher as well on you in the future. Getting a deduction in 2 years might make more sense than right now.
Okay, let's wrap up on the most complicated one, family foundations. There's obviously other more complicated things you can do even beyond this, but let's talk about family foundations. Who are they for? What do you do with them? How do you fund them? And then there's some rules about money that you have to gift out after you set them up.
Yeah, I think this is one of the most complex areas, and really designed for those families that have, as part of their core principles, is charity and donating to charity, and those that have the access to the funds and the wealth to really leave a legacy of those family foundations, to give to charity over time. It's they can certainly be complex. There's different reasons to do these, and I would say, it's really a specialized area. There's also, kind of as a subset of family foundations, there's charitable trusts you can set up as well that have different rules in terms of when you make contributions, you get a deduction for it on your income tax return, but then there's requirements for payouts, in terms of to the charities over time and to beneficiaries once you were to pass. And so the foundations are pretty similar, but it is kind of its own standing foundation where you need to have a board, and operate it kind of as its own entity.
Yeah, and Chris, I would say with the last two items on the screen here, donor advised fund, family foundation, they tend to be a portion of what families will do, and they may have, for example, a few kids, 2 or 3 kids or 4 kids. They're going to be leaving money to those children, but then a lot of times what we see is they're carving off part of their net worth at the end of their life too, and that's going directly to either a donor advised fund or a family foundation, so that they have a certain piece of their net worth designated to those charitable interests, where there's at least some rules around how the gifts are given out after they're gone. I think that's kind of the key with both of those.
Mm-hmm.
So, okay, let's keep going here. And this is the big one. This is the inheritance tax. Right now, with inflation in the mix, a married couple gets $27.22 million that they can, on a federal level, give to their next generation without any federal tax issues. Obviously, Illinois has got its own set of problems that kick in at $4 million. But the proposal now in Congress, like you have mentioned, is that by 2026, that $27 million could drop to $14.65 million. Still sounds like a lot of money, but for many of our clients, when you start doing the math on compound interest and you look at how stocks have done the past 10 years and how we expect them to do in the next 10 or 15 or 20 years, there's a possibility a lot of people could fall in these buckets and be exposed to federal tax issues. So what are some of the things that, and maybe we can talk about this in the next couple slides, but what are some of the things that we can start thinking about with getting money out of our estates now to avoid some of these big federal tax issues down the road?
Yeah, this is certainly an area that people should be aware of and considering and thinking about kind of every year. I know that exemption sounds really high, 13.6 per person, but it is going to sunset. That is part of the law in 2026. It will decrease, and it definitely is one of those areas under the Biden proposals that they want to keep that increase in place, or that decrease in place, excuse me. So it's one of those things that people should be considering. And you need to also take into consideration gifts you made during your lifetime. So we'll kind of talk about that in a second, but this is really an area to be working with your financial advisor, your tax professional, and your estate attorney. It's really the area where all three should be coordinating on, to make sure you got all your ducks in a row and not paying this extra tax. So keep in mind too that in order to get that 27.2 per married couple, you do have to, if one spouse were to pass away first, you do have to file a 706 and elect portability, they call it. So you take the unused exemption from the deceased spouse and roll it over to the next. So that is a requirement. You don't just automatically get it. You need to make sure you do file that form, and it is a complicated form. So you want to make sure that you're staying on top of those requirements. One strategy that we've definitely heard of, I haven't had any clients kind of pull the trigger yet, just with the uncertainty on if the exemption will decrease or not. But one strategy is to use up all of that exemption now, thinking that it will decrease in the future. Because the IRS has come out and said there will be no clawback based on if you use up that $13 million exclusion right now. So if you were to use up that 13 million, let's say years down the road, you pass away and that exemption is at 7 million, they're not going to take that extra 6 million that you already gifted or transferred during your life away and tax it again. So they have come out and said that, and that's important because the exemption has never decreased in the US. So never in our history has this actually gone down from what it has been. So it's definitely a strategy that some higher wealth clients are thinking about. I haven't had anybody pull the trigger on that yet, but that is a possibility, is to just use up that exemption by doing gifting or by contributing to an irrevocable trust, let's say. So there's certain ways to do it, to use up that exemption now and not have any clawback in the future.
Yeah, and Chris, I think this is important too, because that tax rate kicks in at 40%, and not only do we have to worry about the federal limit, but for all of our clients in Illinois, Illinois is much lower. And then walk us through how Illinois works, because from what I'm familiar with, it doesn't just go on a bracket basis. If you have $4 million and $1, it goes back to $1 as a tax rate. Is that correct?
Yep, that's a very expensive dollar for you. So as soon as you hit 4 million and one, it reverts back to the tax all the way down to, starting with the first dollar value. So it's really an interesting system. Illinois does have a good calculator on their website. If you take a look, and if you just want to plug in some of your, maybe your own numbers, maybe where you think you'll be in 5-10 years in asset value, just to see what the tax is for the state. You might be surprised at how they calculate it. So it's not just a regular bracket system. But there's certainly ways to be thinking about this. And if you do take proactive measures over time, you can really reduce your estate through some different things. There is an annual gift limitation. So the annual gift amount for 2024 is 18,000 per person for the whole year. So that means that you can give any individual 18,000, and that's all you have to total up all of the gifts throughout the year. But if you give less than that amount, it doesn't reduce that lifetime exclusion for you. And what's nice is married couples can each give that 18,000. So let's say they have a child, married couple can give 36,000 combined. There are certain rules about actually filing a gift tax return, and you should definitely consider that and potentially need to split the gift, as they say, on the tax return just to report it. But married couples can give that 36,000, especially if their child is married. They could give each their child and their spouse 36,000. So if you do that over time, that can really reduce one's estate just by doing some of this annual gifting without even needing to use some of that lifetime exclusion. So it's a great way to transfer money.
Well, that's a great point, Chris, because a lot of this, I mean, in estate planning and how did the wealthy kind of avoid some of these big taxes that can come in, I think a lot of it comes down to where's the money actually compounding? Is it compounding under your tax identification number, under your Social Security number, or is it compounding in some sort of irrevocable trust, or is it compounding under somebody else's Social Security number? And I think that's really the key. That's how a lot of people can plan for this stuff. But part of the problem is I think a lot of people who are starting to run into, whether it's the Illinois limit at 4 million or maybe even the federal limit at 27 million, I don't think they ever dreamed in a million years that they'd have the money that they have today. They've been saving, they've been investing, they've watched their stocks go up over time. And I don't think they ever dreamed that they would have the wealth they have now. And so a lot of this would have had to be advanced planning work that happened 5, 10, 15, 20 years ago. And that to us, at least with the family office approach, is the key. You have to start doing this planning well in advance. And you got to have your CPA, your advisor, and your estate attorney on the same page. Otherwise, you're going to miss some of this stuff along the way.
I totally agree. Yeah, it's one of those things to always be keeping in mind as you move forward, and not just worry about your current year tax bill, but to take a look at the whole picture, all of your investments, and really planning in advance can really help, as you've seen on the wealth management side in terms of just the assets at retirement. Longer term planning can really accumulate a lot of wealth, and same thing on the tax side. Some long-term planning can really save on a lot of taxes.
Well, and I think just going back to this last slide here, I think the lesson for all of us is try not to die in Illinois. Is that correct?
Yeah, I would say the old adage is Illinois is a great state to retire in, but not die in. So if everyone knew when the date that they were going to die, they would make sure that you don't live in Illinois. That's the takeaway.
Well, talking about some of that relocation too, we've had some clients where they'll try and change their residency to Florida or Arizona or Texas or maybe Tennessee, somewhere where their tax rate's going to be a little bit more favorable, and then an immediate IRS audit or an Illinois state audit is triggered, and now they have to go through and produce all these records. Is that something that you can kind of help people prepare for, is relocation or changing states in retirement?
Yeah, we have a checklist that we utilize with our clients when they are thinking about moving states, because there's more that the state would look at than just your tax return, where you say you're resident or not. They're going to look at other things like your voter registration, where your driver's license is. Even seen cases where they're looking at your general doctor, where's your main physician located. Especially, one of the easy ones too is if somebody leaves Illinois, is they need to remove that homestead exemption on their property taxes. I've seen cases where they ding people and still consider them residents because they're still claiming that resident exemption on the property taxes. So we have a checklist we go through with our clients, and it's really just making sure you got everything in a row, and really ultimately just do change your domicile. There's all kinds of people that just want to say they live in a different state. Even if you spend the majority of your time in a different state, Illinois can still kind of claw back and try and tax you as a resident.
Yeah, Chris, let's go on to this really important point too about stepped up cost basis. And this gets back into the issue of what kind of assets do you want to leave to the next gen? And let's walk through what is the stepped up cost basis, how does it work, and why is it such a great tax strategy for many of our clients?
Yeah, this is I think as we kind of move into the cost base, the step up in cost basis, the reason we have this is because of the estate tax. Because there is a tax on the value of one's assets when you pass, they do give this benefit in most cases of the step up in basis. So basically the assets that somebody holds when they pass away, let's say, yeah, it is $100 per share of Apple stock was their cost. What you do when somebody passes away is look at the fair market value of every single asset, and that is the new cost basis. So if it was $200 as a value on the day that they passed, that is the new cost basis. So if their children inherited that stock and sold it the next day, as long as it was the same value as the day before, there's not going to be any tax on that sale. Whereas if the parents had sold it while they were still alive, they would pay tax on that capital gain through there. So that it's really taking a look and planning with what assets are you going to hold throughout the rest of your life, and what do you want to transfer to your beneficiaries after you pass, and trying to maximize this rule. I think it's very commonly referred to that step up in cost basis, but it also can step down. So it's important to kind of take a look at everything and make sure you're aware of your assets, because you do have to take that fair market value. So especially real estate might be lower. When somebody passes, something like that, an asset like that might have a lower cost basis than they originally had. So it's important to kind of keep that in mind, but with a little planning, you can maximize this area of the tax code. But like I mentioned too, with Biden's proposals, this is an area with the really high kind of built-in gains. They want to remove that exemption. We're talking like 5 million, 10 million of step up in basis value that they'd want to get rid of. But this is certainly an area that anybody can take advantage of with some planning.
Yeah, it's really, I think, Chris, the name of the game now after the CARES Act, after the Secure Act, and the Secure Act 2.0 has really been, where do you shift assets? And for a lot of people, it's making a lot more sense to try and shift from pre-tax to after-tax. And a lot of our strategy is, be somewhat hedged as you get into your retirement years, and then across the time from it takes you to get to from retirement to maybe age 75 or whenever your RMD age is to slowly but surely work yourself more and more towards after tax assets. And then one of those benefits at the end of your life is to pass down money on a stepped up cost basis. So that's fantastic. Chris, thanks so much for that. I know we brought this slide up, and I'll let you finish off on this one here. But what is this? And we mentioned it's the Thomson Reuters custom tax analysis. How are you using this with our clients, and why is it so beneficial?
Yeah, this is something we're using on a consistent basis with our clients, and it's really just a way for us to put numbers together and project their tax situation, which leads to conversations about so many other things. So it's really just at its core, just a simple tax projection. What we think, we plug in the inputs of where the income's at now, where do we think it's going to go, and what we do is we utilize this to consistently update throughout the year, throughout multiple years with our clients, to track both their income, taxes relating to that, and then open up the conversation to what kind of tax savings are out there for their situation. And maybe it's not even tax savings. Maybe they're after taking a look at it, we go through this all the time with clients, and maybe instead of wanting to reduce the tax bill by contributing to those pre-tax retirement accounts, maybe they're going to instead just opt to contribute to the Roths. And because we've broken down all these numbers, they see how they're being taxed, and they just decide at that point, let's opt for the long-term growth in the Roth. So conversations like that we're having every single day with our clients, and utilize this tax projection to really break down the numbers so you can see it pretty clearly, and leads to so many other conversations that we consistently update throughout the year.
Yeah, that's great, Chris. And for everybody watching today, take down Chris's info. We'll send it out to you so you have his direct contact info. It's on the screen in front of you. But this is a complimentary takeaway that we have for you: is talk with Chris, do a one-on-one consultation, and get a little bit more specific about your tax planning. You can see in this example, even that Chris put together, some of the tax changes that hit in 2026 are included in this analysis. So highly recommend reach out to Chris, get something on the books. Don't wait till things change. Get ahead of it and get on the planning side of things. Something I always hear Chris say when he's talking to one of our clients is it's not just about the compliance issue, which is filing the tax return. That's a huge piece of it, of course, but it's more so about the advanced planning. It's the strategy work, and that's the intersection of the multifamily office approach like we have at Stenger Family Office, is to have your entire team in one spot. So not only do you have your investments, your financial planning, but you have the tax piece coordinated with the estate planning. You've got everything in one spot under the same roof. So you're not missing some of these big things that are coming. And we unfortunately have had this happen to people over time where maybe the CPA is on an island somewhere, the attorney's on an island, nobody's coordinated together, and there can be some real money at stake long term. And you may not care at the end of your life where it goes exactly, but if you're like our family, you'd rather give it to charity than leave it to the federal government. So there's some easy stuff that you can do now just to make sure that you're well planned for the future. And then just one last point we'll make here on tax efficient investing. We'll get into Q&A in a second if anybody's got any last minute questions. But this is the intersection between tax, what Chris does, and then what we do on the investment side. Just watch where you're taking your capital gains. If you're in a lot of mutual funds, remember Stenger Family Office does not use mutual funds because they're tax inefficient. They pay out capital gains without your consent each and every year. I would recommend have our team take a look at what you have now and make a proposal on either getting you into what we call direct indexing, which is individual stocks tailored to your needs that can provide a lot of tax benefit. There was the ETF wave that came in 2003. We were one of the leading groups with that. We were on the front page of Barron's, highlighted for our use of exchange traded funds, which are a huge innovation at the time and were a huge tax savings. Well, now the ETF business is quickly turning towards this direct indexing, and that appears to be the wave of the future. So we can talk to you a little bit about that. And then finally, just hold your income generating assets in IRAs. This is a general piece of information here, but we like to hold income generating assets in IRAs where you're going to be able to defer the tax and then keep your appreciating assets, stocks maybe that you think are going to go up more than they're going to produce income, in your after-tax accounts, because as long as that stepped up cost base is in effect, you should be able to pass that down to the kids without having tax paid. So that's some of what we do here at Stenger Family Office. Let me turn it over now to Q&A. We did have a couple questions bounce in here while we were talking. We had one on QCDs. If you've got a question, type it in the chat bar. Chris, I'll kick us off with just one basic question. And we get this all the time from our clients is, are there any ways that I can just save money on taxes right now? Are there any interesting credits out there or anything that I can take advantage of today rather than having to wait 10, 15, 20 years down the road?
Yeah, I think it's always one of the biggest questions. Everybody's situation is different. The one thing with trying to maximize some credits or deductions is, even though you might follow the steps to get that credit, let's say, but there are typically income limitations. So you need to make sure you're kind of doing some planning ahead of time with your situation. One of the biggest ones that's out there right now is just these energy credits. And the government's really just trying to spur more investment into energy savings, especially the like electric vehicles. So that's probably the biggest one you'll hear about out there. But again, even that electric vehicle credit has income limitations on it. So I've had one client that bought a Tesla and thankfully came in right under the threshold to get the credit, because that does influence some people's buying habits. But a lot of the energy credits, things just around your home, that's probably one of the simplest ones. But kind of looking at all of your tax savings and accounts, and really just trying to maximize things. We see a lot, especially with the market past couple of years, is just a lot of capital gains in there that either weren't expected, especially from those mutual funds, but really just trying to offset those any losses in the account against the gains, trying to minimize your tax it each year, is something we constantly see.
What about agricultural credits? We get that question quite often too. Some people will have farmland, they'll write off the equipment. What are some of the benefits with agricultural credits?
Yeah, if you have if you have a farmland, there's pretty specific tax codes on that. But the one thing we've seen with a lot of the tax write-offs is, for those like businesses, agriculture, is the direct write-off of like fixed assets, things like that, is being reduced over time. I guess we should mention too, there currently is a bill that passed the House of Representatives that's sitting in the Senate that would affect a lot of these rules, would even affect the child tax credit. And the bill that passed the House would affect 2023, that most people have already just filed for. So there are constant changes going on, but a lot of those things are kind of limited. The other big thing that we've seen is just investment in research and development costs. One kind of unintended bill, I guess tax provision that came from the TCJA was this write-off of R&D costs over time. Before, you would just expense those in the moment whenever you incurred them, and also can get a benefit from this R&D tax credit. But starting with 2 years ago now, you have to spread those costs over time and can't immediately deduct them. So I think that was one thing that was written into the initial bill that nobody really thought would ever stay. Thought they'd fix it in time, but we're 2 years in now, and that still hasn't gotten passed.
Is it a good thing that the SALT deduction was eliminated? It seemed like it was kind of a subsidy for high tax states, but obviously all the people in the high tax states probably don't feel like that. So net benefit to the rest of the country. I mean, what are your thoughts on getting rid of most of the SALT deduction?
Yeah, I think the SALT deduction definitely affects more of the higher income earners, more of the wealthy, and more of those in those high tax states. But I see it affecting everybody across the board. Especially those, a lot of our clients in Illinois, if they do live in a higher property tax, Illinois does have its own 5% state income tax, which is high, but not one of the highest, thankfully. But the property taxes are up there. So I've seen clients that are just on their main home are getting limited by that. So I think it's one of those areas that if it does get eliminated, it will benefit a lot of the higher income earners, more of the wealthy, but even average average employees, those people less than the 400,000 would benefit from removing that limit as well.
Chris, who's going to win the election? No, I'm just kidding. We won't ask you that. Okay, what about let's wrap up on one last question here. In general, what's one of the best strategies that you've seen people use that are, let's say, kind of in that $200,000 in income range, maybe working, so they're paying payroll taxes? What are some of the easy things right off the bat? Maybe give us 3 things that somebody in that zone can do to help their tax situation long term.
I think first is looking at those pre-tax and after-tax retirement accounts. I think retirement savings and charitable donations are really the 2 huge areas to either defer tax or save on tax. So first looking at like, the pre-tax, post-tax, retirement accounts are one of the simplest ones. And I think people just assume that they should just always go pre-tax. It's kind of just assumed that, save for retirement, traditional IRA, traditional 401k. But depending on your age, depending on how many more years you have till retirement, depending on your current bracket, I think it makes a lot of sense to do a mix of both, or to totally fund a Roth. I think that's one thing we've seen more the past 5 years or so is going more after tax route on the retirement side. So again, it's funny when we talk tax savings, everybody wants to save on their taxes, but sometimes you don't need to. Sometimes it's going to be better long term by saving on tax 20 years from now, pulling money out of your Roth IRA that's appreciated in value, that has no tax on it, compared to getting a 22% deduction 20 years beforehand. So I think that's one of those things. Maximizing too, in the real estate market, we haven't really touched on rental properties. That's kind of a whole different area of the tax code, but even somebody's main home, there is a gain exclusion currently, of 250,000, as long as you meet some qualifiers, like it being your main residence for at least 2 years out of the past 5. So as long as you kind of meet those thresholds, if your main home appreciates in value, you can exclude a lot of the gain, if not all of it. And married couples each get $250,000 combined. So that's a huge one that I don't think will ever go away. That one's pretty stable. But people don't really talk about it as much, just because it's kind of assumed that you don't pay tax on your main residence. So that's one that's out there that doesn't really get talked about a lot, but is really a huge savings for individuals.
Yeah, that's awesome, Chris. Well, thanks so much. Thank you, everyone, for dialing in today, joining the webinar. And Chris, we're going to find out about this updated tax bill pretty soon, I would think, right, in the new year?
Yeah, I would say so. I would kind of leave you with this. I always think back to when the TCJA was first passed, and it was passed, like we mentioned, right at the end of 2017. Taking effect, basically a week later. But the tax bill doesn't just come out of nowhere overnight. So you're going to have probably, at least a month, if not longer, once the bill's even first introduced to the House, to see what's in there, see what gets updated, and, listen to all the media talk about it. So, excuse me. So be planning, be tracking this. And, there's a lot of things you can do to prepare for a tax bill before it's even enacted. So even right now, like we talked through today, there's so many things you can be planning for and talk around these bills that aren't even bills yet, but you can start the preparation now. So once a bill is passed, you can kind of flip the switch and be ready for it.
That's fantastic. Thanks, Chris. Yeah, we'll be updating you. If you keep joining us for these webinars, we'll keep updating you on the tax codes and what's coming down the pipeline, how to prepare. Thank you for being on today's webinar. Again, Chris's info is on the screen. Give him a call, shoot him a text, or email him, visit us online. You can check out Chris's content online as well on our Stenger Family Office website, and book a one-on-one meeting with him. Get that Thomson Reuters tax analysis done for you and your family, and start doing that strategic planning. Again, the Stenger Family Office approach is to have everybody coordinated, your entire team under one roof, so that you're taking advantage of all the different tax benefits that are out there, and that you're also prepared for the future. That's the big point of why we've got everything coordinated. So thanks for being on. We'll see you next time. Thanks for being here.